Silver has just literally fallen out of bed, and it is trading below the simple 50-day moving average. That's at 76.21. Silver is currently at 74.22. That's what they announce on the news. The Dow is up or down, and they're referring to close to close. So when you get these long red candles, it means that there's tremendous selling pressure. Below that is what we call the wicks, the area of about $70 based on what happened at the end of December and beginning of January of this year tells me that's where we want to look for potential support in the market.
I mean, we've seen a pattern where silver trades higher during the Asian session, it then gets hit when the U.S. market opens. I mean, a lot of this selling was mechanical, leveraged ETFs and kind of futures margin calls.
By the end of this year, gold could be back up at around 58. It could even touch 6,000. When we look at the actual sell-off, gold came down about 700 and closed down 500. Don't believe that what we're witnessing is the end of a bull run.
I want to start with spot silver. I mean, well, you'll look at futures. We always look at spot over at Kitco. You'll look at futures, but it's currently trying to stabilize in the mid, 70s? But the story of the day was the drop into the low 70s. I mean, look at the chart structure. Back in January, by the way, just at the early of the month when we had you on, you identified that low 70s, specifically about $71 as the trend definition level. It's the market's liquidating right down to that zone, and it kind of bounced a bit. I mean, what are your thoughts? What is this test of support? Is this, sheer velocity of the selling break? What are your thoughts?
Well, the first thing I think that's very important to realize is when we look at a price change over time in any commodity, we're looking at whether it's a fundamentally based move or a technically based move. In the case of the sell-off in gold and silver, I have to believe that fundamentally not that much has changed. We do have a new Fed chairman coming in, and so there's questions that are raised in terms of the uncertainty there. But all the fundamentals that move this market up continue to be in place.
The sharp drop looks dramatic, but the foundation underneath metals hasn't cracked. As Gary Wagner explains here, the move toward the $71 support level appears technical rather than fundamental. Inflation remains above the Fed's 2% target, and commodity demand drivers haven't meaningfully shifted in early year macro data. When liquidation happens this quickly, it often reflects positioning unwind rather than economic reality. Investors should remember that technical support zones frequently attract institutional buying interest after panic selling, and what Gary Wagner suggests next reveals whether this support level can actually hold.
Inflation has been steady. It hasn't really gone down where we want it. When I say we, it's not me. The Fed's 2% target, we're still well above that. The economy is showing some signs of weakness. Of course, we didn't get the jobs report this week, so everybody's looking at the ADP report that came in well under estimate. So there's some concern about the labor market. Typically, what the Fed does to shore up labor is to cut rates. That should be good for gold, good for the precious metals, but yet we see them coming down.
Yeah.
And so that tells me that large institutional traders, some speculators, are taking money off the table. In other words, what we've witnessed is a market that has been extremely hot. When you compare gold to silver, I look at it as a candle that burns at both ends, burns twice as bright, but tends to go out quicker. And that's what we're seeing with silver. Silver has just literally fallen out of bed. When we look at, for example, price action on this one day, a 7% drop, the wrong day, 26% drop, $30 in a single day. And it went from an opening price of 115 and closed at 85. Then it fell further. We saw the same thing in gold. Here we had 2 days in which the market came back, and now it's back down.
Rate cut expectations usually lift metals, yet prices are falling. The contradiction matters. as Gary Wagner points out here, inflation remains above target, while labor data like the weak ADP report raises slowdown fears. Silver's 26% single-day collapse reflects speculative excess more than macro deterioration, similar to crowded commodity trades seen in 2011 and 2020. When institutional traders unwind leverage simultaneously, price declines can overshoot fundamentals dramatically. This kind of volatility often signals positioning risk rather than economic collapse. Next, Gary Wagner explains why technical damage matters more than headlines right now.
These lines are important for what we call technical views. Market technicians consider a market to be bullish if it's trading above the 50-day simple moving average, bearish if it's below. Silver is below, that is this dark blue line, and it is trading below the simple 50-day moving average. That's at 76.21. Silver is currently at 74.22. This bases the March futures contract.
Yeah, wow. Look at that chart. I mean, let's talk about those candlesticks for a second. We see that massive, long lower shadow on today's candle. And I got to ask you, what's next? I mean, in your technical playbook, does a wick that long signal that this liquidation is finished and buyers have stepped in, or is it just kind of a dead cat bounce before lower lows?
Well, when you look at a candlestick, what you want to do is look at first the rectangle. The rectangle is color-coded in red or green. Red on this chart simply means it opened and then closed lower. Green means it opens and closes higher. In a bullish market, we want to see green candles, meaning it closes above its opening price. It's interesting in terms of the philosophy of a Japanese technical analysis in what they focus on.
Breaking the 50-day moving average often matters more than the daily news cycle. As Gary Wagner explains here, silver trading below this technical level signals momentum deterioration that institutional algorithms closely monitor. Historically, commodities falling under their 50-day average often test deeper support zones before stabilizing. The long lower wick may suggest dip buying interest, but technicians focus more on candle body size and trend confirmation over multiple sessions. This is where short-term traders and long-term investors interpret the same chart very differently. Next, Gary Wagner clarifies why candlestick psychology reveals who actually controls the market.
When I say that silver closed down $10 or $50, we know intrinsically what I've said is I've compared the close of yesterday to the close of today.
Yeah.
The importance that Western traders place on a close-to-close relationship is tantamount to one of the most important things. That's what they announce on the news. The Dow is up or down, and they're referring to close. To a Eastern technical trader, the most important information they can derive is, did the market close above or below the opening price? Because they view the market session really as a battle, and red tells you that the bearish faction was able to overwhelm the bullish faction, and the reverse with the green. So when you get these long green candles, or long red candles, it means that there's tremendous selling pressure. Below that is what we call the wicks. And the wicks are the difference between the real body, the open and close, and the low and the high. Very small wick on this one brutal day. Kind of a long wick on the lower one, but the body size is so much larger than the wick where we have to focus on body size.
Most investors watch closing prices, but professional traders watch the battle inside the session. As Gary Wagner explains here, candlestick bodies reveal whether buyers or sellers truly controlled the trading day. Large red bodies historically indicate strong institutional selling pressure, similar to commodity liquidation phases during 2008 and March 2020. The small wick relative to the candle body suggests sellers dominated from open to close, not just during brief volatility spikes. That distinction matters when assessing whether markets are stabilizing or still under distribution. Next, Gary Wagner shows how these signals help identify real support levels.
So when I look at silver, I can see that towards the end of December, silver consolidated right around 70. You see these series of bottoms, whether they're green or red, and then it ran aggressively to the all-time record high. When it came down, these wicks have touched near this point, and the fact that it's below the 50-day moving average tells me that we could be seeing a pivot. I'm not convinced yet. I need to see multiple days and further declines. But I draw your attention to this one area, because the area of about $70, based on what happened at the end of December and beginning of January of this year, tells me that's where we want to look for potential support in the market. You can also see these wicks came very close. So this is the line in the sand in terms of whether or not what we're witnessing is a deep, 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 but brutal sell-off that is really been instigated, implemented by traders taking money off the table, profit taking. Profit taking is different, obviously, than a fundamental shift. We haven't seen the fundamental shift. We have seen a technical sell-off.
The real battle in silver right now isn't fundamentals. It's technical damage control. As Gary Wagner points out here, the $70 level has quietly become a psychological and structural support zone traders are watching closely. Breaking below the 50-day moving average historically signals momentum loss. And silver has now done exactly that after a record high surge. Since 2010, similar technical breaks in silver have led to extended consolidation phases rather than immediate rebounds. For investors, this looks more like repositioning than panic selling. Next, he explains why global trading sessions matter more than most investors realize.
Yeah, good point. And, I got to ask you this, because I always get questioned as well. We've seen a pattern where silver trades higher during the Asian session, then gets hit when the U.S. market opens. From a technical and future market standpoint, what does that tell you? Because we know a lot of this selling was mechanical, leveraged ETFs and kind of futures margin calls.
It could be a number of variables. Typically, the Asian markets have been very aggressive in bidding both gold and silver higher. And then we've got really, in the old days, I say that with some humor to it because it wasn't that long ago.
Yeah.
There were market sessions. We opened at 9:30, say, and we closed at 3:30 in gold. And then the night we came on, and then you had the next morning session. So if anything happened during that nighttime void when things can happen, but at the same time there is no futures market where you can implement a trade, is much different than the 24-hour markets that gold and silver have gone to. In other words, I'm going to give you Hawaiian time. You just have to add 5 or 6 hours to get Eastern. But opens on Monday. On Monday at a certain period of time around 1 in the afternoon, it's closed in New York. It goes to Australia, Hong Kong, then London, and it circles all the way until Friday. On Friday, New York closes. It closes the week. It stays closed until Monday morning in Australia, the first market to open, which is Sunday here around 1 o'clock.
What looks like manipulation across time zones is often just liquidity rotating between regions. As Gary Wagner points out here, 24-hour metals trading means price discovery never truly stops, unlike older session-based markets. Asian demand frequently pushes metals higher overnight, while US futures markets, where leverage is highest, often drive sharper sell-offs when margin calls hit. Nearly 70% of global futures volume still clears through US exchanges, which explains the pattern many investors notice. For long-term portfolios, this reflects mechanics, not conspiracy. Next, he connects this continuous trading cycle to stop-loss behavior.
So there's all these opportunities. We never have a void in which you can't place a trade. And so what that tells me is that it's not a series of stops that just got hit because the market opened. And a stop definition is that if you put a price stop, good, kill, cancel stop, when it hits that price, it's executed at the best available price, which means that if a market closes at 75 and on a Friday and then opens at 65 on a Monday, your $70 stop didn't get you out at 70. It was never there. It's executed at 65. So because we have 24-hour markets, we have a smoother transition. We have less gaps in the data, meaning price voids. Technicians look for that to get filled. This has just been solid and strong selling pressure. Absolutely.
Yeah.
Many investors blame stop-loss cascades, but continuous markets tell a different story. As Gary Wagner points out here, true price gaps are far less common in modern metals trading because markets operate nearly 24 hours a day. That means the recent decline reflects sustained selling pressure, not a single mechanical trigger event. Historically, extended selling waves like this often coincide with leverage, ETF unwinds, and futures liquidation cycles. Retail traders often underestimate how institutional positioning drives these moves. Next, he explains what gold's resilience may reveal about investor confidence.
Gold, it feels like it's holding its moving averages a little bit in the mid 4,800 range. I mean, strictly from that technical perspective, what is the divergent telling us when the high beta asset like silver crashes, but gold holds its trend line a little bit? I mean, is it a sign of relative strength for the complex?
It's a sign that the profit taking isn't as brutal. I mean, when you look at both markets sold off very, very strongly, but when we look at the actual sell off, $500, but in actuality, gold came down about 700 and closed down 500. Mm-hmm. Same moving averages, 20, 50, and the red one is 200-day. Unlike silver, which closed below the 50-day moving average, gold has closed at the simple 20-day moving average. The 50-day is far below it. It's at about 4,500. So in terms of, if you're to ask me, have we seen any strong technical chart damage in silver? Because it closed below the 50-day simple moving average, the answer has to be yes. That's the definition of chart damage, is breaking through a critical level. However, I do believe that we're very close to a potential level of support. With gold, it came down very harshly, but then we had this really strong update that came in. Then we get what's called a doji. A doji is this one candlestick that looks like a cross, and that only occurs when the open and closing price are identical or one or two ticks apart.
When silver collapses but gold holds trend support, institutional money is quietly choosing safety. As Gary Wagner points out here, gold remaining near its 20-day moving average while silver breaks the 50-day is a classic divergence signal. Historically, during metals corrections in 2008 and 2020, gold stabilized first while silver lagged before recovering. A doji candlestick often signals market indecision following heavy volatility, not immediate reversal. For investors, this suggests defensive positioning rather than panic liquidation. Next, he hints at what confirmation signals traders are waiting for now.
It typically tells you that neither the bullish faction or the bearish faction is able to dominate price action in the market, but then the following day, today, it sells off again. Right. What's interesting is you do not get any wicks that go anywhere near the 50-day. The only day we had that was on Monday. Okay. So it's selling off, but in terms of the amount that it's sold off, it's not been as brutal as silver, but then silver's outperformed gold on the way up in terms of percentage gains. And that is something we typically see because of the volatility, intrinsic volatility in silver, and the larger number of contracts traded in gold.
And I'm just curious, I mean, Gary, if gold were vulnerable here, what would profit taking actually look like on the chart? I mean, would it be larger real bodies, kind of heavier volume on the down days, or failure at those key moving averages? You said what, gold hasn't touched 20 yet?
The 20-day moving average is this first, the highest one. And that's not exactly, but it closed right in that area. You can see that the close of today and the 20-day are pretty much the same. You can see that on Monday, the wick broke below the 50-day, but the real body, the red body between the open and close, remember, if it's red, it opens and it closes lower. It means that it traded to these lows, but then money came in, traders bought that dip, moving it back up, and that's showing you some strength.
A sell-off that looks weak on the surface can actually signal quiet institutional support underneath. As Gary Wagner points out here, gold holding near its 20-day moving average, while buyers step in after dips, suggests accumulation rather than distribution. Historically, when gold rebounds after briefly testing lower levels, it often reflects fund managers rebalancing positions instead of exiting entirely. Silver's larger percentage swings reinforce this normal volatility pattern between the two metals. For investors, the key signal is dip buying behavior, not the red candles themselves. Next, he explains why support levels matter more than headlines right now.
If we look at different areas in terms of potential support, if it continues to fall, 4,600 is a logical, with major at 44. But I really believe that we've seen so much selling pressure, and the fact that the fundamental matrix of the economies, the global scenario in geopolitical terms hasn't changed all that much. There is a skirmish in Iran and protesters, and our government's going to meet with them, and whatever comes out of that comes out of that. But there have been veiled threats from the Americans about if they don't get rid of their nuclear production, not arsenal, so to speak, that there could be a military action. That is the kind of talk that typically energizes safe havens like nothing else, and yet we have it falling. Yeah. So it's an interesting combination of what we see in the world and what we're seeing in the gold price and silver, and it all comes back to the one conclusion that I've drawn for this entire decline, and that is it is a decline based on technicals and selling pressure, even more than technicals, selling pressure, taking profits, more than a shift in the fundamental environment that has moved these metals higher.
I was going to say, it just felt like a bit of a crowded trade there, right? I mean, we had analysts talking about Costco, we had taxi drivers talking about it. That's kind of what you're talking about.
Exactly. A very crowded field for the metals.
When geopolitical tension rises, but safe haven assets fall, markets are telling a different story than the news cycle. As Gary Wagner points out here, gold declining despite Middle East tensions suggests positioning unwinds rather than fear-driven selling. Historically, crowded trades often reverse quickly once retail participation spikes, a pattern seen during the 2011 metals peak and the 2021 commodity rally. When everyone starts talking about one asset, institutional money is often already rotating elsewhere. Investors should focus on liquidity flows instead of headlines. Next, he explains why crowded trades rarely end quietly.
Hey, I got to ask you, I mean, on the gold front, because last time we had you on, I mean, it was on such a tear, and you were accurate. I mean, it ran up to 5,500, but you previously targeted that $5,700, $4,800 zone as kind of a technical buy area. Now that we're testing the upper end of that range, does the chart still support a move towards 5,000 later this year? Do you think we need to consolidate here first? What's your outlook?
I still believe there is a high probability that by the end of this year, gold could be back up at around 58. It could even touch 6,000 if we get into the kind of frenzy that we got towards the end of last year. It's quite possible. Anytime the market corrects like this and it's based on profit taking, it tends to be exaggerated. It tends to be a little shorter because What happens once you take that money off the table and the price comes down, traders can re-enter at a much more favorable price and move the market back up. I personally don't believe that what we're witnessing is the end of a bull run. It could be, but the technical evidence at this point for gold does not support that theory.
Bull markets rarely end during profit-taking phases. They usually end when liquidity disappears. As Gary Wagner points out here, corrections driven by positioning resets often create re-entry opportunities for institutional capital. Gold, reaching towards 6,000, would require conditions similar to late cycle momentum phases seen in previous commodity runs. Historically, metals bull markets include multiple sharp pullbacks before continuation, sometimes retracing 15 to 20% during the trend. For long-term investors, the distinction between correction and reversal matters more than daily volatility